Welcome back to your ultimate pit stop, Piston Pundit. What once sounded like a late-night punchline, buying Greenland, has slammed into the real economy with the force of a missed downshift. As rhetoric hardened into tariffs and alliances strained, markets reacted the way drivetrains do under sudden load, vibrations first, then failures. For automakers already juggling electrification costs, reshoring, and fragile supply chains, this wasn't theater, it was risk. In this episode, we unpack how the Greenland Gambit rippled through trade, capital flows, and the global auto ecosystem. Here are the developments. The Greenland play, from joke to global market shock. The Greenland flare-up didn't ignite overnight. It was built on years of Arctic tension, rare earth access, strategic sea lanes, and military posture. Greenland's semi-autonomous status under Denmark suddenly mattered far more once the idea of acquisition resurfaced, this time paired with economic muscle. When pressure escalated from talk to threats, investors recalibrated almost instantly. Think of it like adding boost without reinforcing the internals. Trump framed the move as national security, NATO drills, foreign activity, but bolted tariffs onto the argument, turning geopolitics into a torque spike markets hadn't priced in. That timing couldn't be worse for autos. OEMs are already balancing EV capex, hybrid demand, and brittle logistics. Introduce coercion between allies and production planning turns into educated guesswork. Capital hates uncertainty, and so do assembly lines. But geopolitical pressure didn't stop at rhetoric. It quickly morphed into something markets understand all too well: tariffs. Tariffs as a weapon, turning allies into targets. Tariffs became the primary lever, 10% upfront, escalating toward 25% unless Europe complied. This wasn't framed as negotiation. It was a pressure plate. For automakers, warning lights flashed immediately. European brands depend on U.S. demand, while U.S. manufacturing relies on European inputs: gearboxes, precision castings, advanced tooling, and engineering IP. Tariffs don't stay contained. They ripple through bombs, MSRPs, dealer margins, and ultimately consumer wallets. At a moment when EV adoption is fragile and hybrids are carrying the load, price shocks are especially dangerous. Consumers feel it first. Manufacturers feel it longer. European leaders pushed back fast, reminding Washington that recent trade agreements were meant to stabilize, not weaponize relations. Finance ministries worried most. If deals can be revoked at will, long-horizon investments like battery plants and shared platforms suddenly lose their math. Before we go further, do us a favor and smash that like button and subscribe to Piston Pundit. It helps us reach more gearheads, builders, and industry watchers just like you. And it keeps this pit stop running strong. Now let's shift gears and look at how Europe answered back. Europe's countermove, unity hardens against US pressure. Europe's response was unusually cohesive. The tone shifted from accommodation to resistance, framing Trump's approach as pressure politics rather than partnership. This wasn't about trade deficits or industrial subsidies. It was about sovereignty, and that distinction hardened positions in Brussels. Behind closed doors, contingency plans took shape, freezing progress on U.S. trade talks, revisiting procurement rules that favored American firms, and dusting off the EU's anti-coercion instrument, powerful, unused, and suddenly relevant. Public sentiment hardened too, particularly in export-heavy regions. For the auto sector, that matters. Brand loyalty, regulatory alignment, and joint ventures depend on goodwill. Lose it, and friction multiplies. Approvals slow, standards diverge, and collaboration costs rise. But political resistance was only part of the story. The real shock came when markets themselves began to react. Markets jolt, the moment Wall Street miscalculated. Investors had grown comfortable with the pattern. Markets coined the term taco trade, Trump always chickens out, the belief that threats would fade before real damage set in. This time, that assumption cracked. As tariff pressure intensified and Europe signaled retaliation, markets reacted like an engine hitting fuel cut at redline. Equities slid, volatility spiked, and safe haven assets surged. Long-dated U.S. Treasury yields climbed as investors repriced political risk, not from adversaries but from allies. For the auto industry, this kind of instability is corrosive. Vehicle platforms are planned years ahead. Battery plants, engine programs, and tooling lines depend on predictable financing and trade rules. And once markets wobble, capital doesn't stay neutral for long. Capital pushes back. Allies quietly question U.S. stability. One of the most symbolic moments came quietly. A Danish pension fund announcing plans to exit U.S. treasuries. The dollar amount was small, but the signal was enormous. U.S. debt has long been treated as the ultimate safe asset, especially by allies. When that assumption weakens, the consequences spread fast. For autos, the impact is practical and immediate. Higher sovereign borrowing costs filter into dealer floor plan financing, OEM credit arms, and consumer auto loans. EVs, already wrestling with affordability, become even harder to move as interest rates climb due to political risk premiums. This moment revealed an uncomfortable truth. Economic coercion doesn't stop at tariffs. Capital itself can respond, slowly, quietly, but with serious torque. And this brings us back to the core question. Why does Greenland matter so much to cars in the first place? Why Greenland matters: minerals, motors, and supply chains. At first glance, Greenland seems far removed from showrooms and assembly lines. In reality, it sits at the intersection of three forces shaping the auto industry's future: critical minerals, security, and supply chain resilience. Greenland holds potential rare earth deposits vital for EV motors, batteries, and power electronics, the backbone of next-generation drivetrains. Secured through cooperation, these resources could stabilize supply. Secured through threats, they encourage diversification away from U.S.-linked ecosystems. Add emerging Arctic shipping routes, shorter paths for just-in-time manufacturing, and Greenland's relevance becomes clear. By turning it into a flashpoint, Washington accelerated Europe's push for autonomy in defense, trade, and industrial policy. Which brings us to the bigger picture and the lasting consequences. Verdict. When power politics hit the global auto engine, Trump wanted leverage. What followed was resistance. The Greenland episode may never end in annexation or open conflict, but its aftershocks will linger far beyond the headlines. Europe emerged more unified. Markets were reminded that allies can generate risk too, and industries built on global cooperation felt the tremors immediately. For the automotive sector, this was a warning shot across the bow. Electrification timelines, battery sourcing, and vehicle affordability all depend on trust between partners. When that trust fractures, costs rise, innovation slows, and consumers pay the price. Greenland wasn't just about territory. It tested whether raw power can replace rules in a deeply interconnected economy. This time, it couldn't. But the damage is done, and the road ahead is undeniably rougher. Now we want to hear from you. Do tariffs between allies pose a bigger threat to car prices than supply shortages? Should automakers prepare for a future built around regionalized production? And did this episode permanently change how you see US-EU economic ties? Drop your thoughts and experiences in the comments below. If you want more breakdowns like this, subscribe to Piston Pundit and hit the notification bell so you don't miss our next vehicle updates and deep dive industry analysis. Thanks for watching, and we'll see you at the next pit stop. You can now check out any of the videos on the screen. There's plenty more to explore.